Jim, you've really worked hard at trying to ferret out areas of positivity, areas where the market is legitimately sniffing out growth. Are you running out of ideas or not?
Well, you know, this is a scary thing, and no one knows how it's going to turn out, and there could be some bad outcomes. There's no doubt about that, Carl. I certainly don't know. But I do think the right thing to do is lean towards the bullish side here, primarily for two reasons. I like two things the most. One is the level of fear is just almost unprecedented. We have the normal fear that you get in a recession about losing your job or losing your life savings in the stock market, but we also have the fear of losing your life or the life of a loved one. And so we've kind of put human emotion on steroids here, and whenever there's really elevated fear, that's always been a good time to buy risk assets overall. And then the other thing is just the policy response, you know, is also unprecedented. It's not just don't fight the Fed. It's don't fight the Fed, don't fight the Treasury, don't fight bond vigilantes in every corner of the globe. And if I just think that probably things as bad as they are going to turn out better than our worst nightmares, and we've got a huge amount of policy support underneath that. So I'd be picking away, like this week when it's bad, at adding a little bit to positions.
Interesting, Jim. You know, Gabriela, Howard Marks is famous for saying that all great investments are made in discomfort, and there's a lot of discomfort now. How does JPMorgan, how do you work with that kind of argument?
So, Carl, we've been thinking about separating the long-term post-COVID investments from the shorter-term COVID world that we're still going to be living in for another year or so. And if we think about the long term, we absolutely do believe we'll get through this. The economy will recover, earnings will resume their long-term trend, and equities are so important for long-term portfolio growth, even more than normal, now that yields have fallen even further year to date. But we have to square that with the uncertain next 12 months or so while we try to figure out how we reopen, what the policy response is, and with valuations that after the April rally had gotten a little bit stretched and left little room for disappointment. So we felt like we still need risk assets for the long term, but it was not the time to ramp up the dial quite yet and go all in on risk. So we still focus on quality bonds for protection and on really thinking about sectoral and regional differences for this COVID world we're still going to live in for another year.
Jim, it's Sarah. Small caps down 10% so far this week, almost double that of the overall market. They're down 30% this year, which is double the loss of the overall market. Is that a warning or an opportunity?
You know, I think, Sarah, I think it's an opportunity, as I say. I mean, the S&P 500 is expensively priced. I grant that. But the broader market, whether you look at small caps or cyclical sectors or high beta investments or the entire international stock market, those are all, as you say, down a lot more and are far better valuations, even from a long-term standpoint. And they're also incredibly underowned. I mean, everyone now is piling into gold at a 50-year high to the overall commodity price index. They're you know, in defensive sectors and low vol investments, cash, overpriced bonds. I think these other areas of the market outside of the S&P 5 and a good part of the S&P 500 names as well represent good long-term values that if and when it eventually turns to more optimism, people are going to find out that they're going to need some of that. Well, I think rather than
which kind of sectors?
Well, I think I just, rather than making a spritz call, I mean, I got a few favorites in there, but I certainly would add some small caps. We are overweight in international markets, have a tilt in that direction. We also take a swing here at the financials. I like the home builders just recently. You know, I think there are some areas that just represent remarkable values being priced in a time of intense fear that probably, I don't know what might happen, Sarah, over the next 3 to 6 months, but I think over the next 12 to 18, I'm going to be pretty happy by owning some of those.
Financials, even with the destruction that we're seeing this week, The continued skepticism around whether they're going to be able to pay out their dividends and the questions about negative rates. You still want to go there?
Man, they're down a lot. They reflect a lot of bad news, Sarah. There's a lot of bad news already in these stocks. And, you know, let's not forget that we've got an incredibly clean banking system. We cleaned it up after '08 and kept it so clean from a financial standpoint. So there's not the same kind of risk that we normally have in these, and yet they're being priced that or worse. And I think some of these things like suspension of dividends, that too will pass. Who knows if it'll ever come to pass, and even if it does, that too will pass. I think it's okay to own some of those right now. And, you know, I really think that as bad as it is, and it might stay bad, it probably turns out better than everyone currently imagines. And if it does, those financials could move mighty fast to the upside.